Welcome to The Explainer. Our job here is pretty simple. We take complicated reports and break them down into something you can actually use.
So today, we're diving into a brand new Goldman Sachs report on Xiaomi. And we're trying to answer a really big question about this tech giant. Is it stalling out, or is it just shifting into a much, much higher gear? All right, so to get to the bottom of this, let's start at the top, right? Let's look at the headline numbers from their Q2 report card. Okay, the first number that just jumps right off the page is this one, a massive 75% year-over-year jump in adjusted net profit. I mean, this didn't just meet what analysts were hoping for, it completely blew past their expectations. So on the surface, that looks like a huge win. But, that massive profit number, it really doesn't tell the whole story. When you dig in, the results were, well, a real mixed bag. On one hand, you've got this incredible growth in their connected devices, their whole AIoT business. And get this, their brand new electric vehicle division actually turned a profit for the very first time. That's huge. But at the same exact time, their core business, the thing they're famous for, smartphones, was actually down. Both sales and the average price they get per phone took a hit. And this really brings us to the heart of the matter, right? The central tension in Xiaomi's business today. It's kind of like a tale of two engines. You've got the old guard, their smartphone business, versus all these new challengers, which is basically everything else they're doing. Now, let's be clear. Xiaomi is still an absolute giant in the smartphone world. I mean, don't get it twisted. They've held on to their spot as the solid number 3 player globally. We're talking almost 15% of all smartphones shipped in the second quarter. That's a ton of phones. Right, so here's the kicker. The really crucial point is this. Even though they sell an incredible number of phones, that part of the business, it's just becoming less and less important to their overall financial health, to their bottom line. And this chart, wow, this is where that shift just becomes crystal clear. The report projects where Xiaomi's profits are actually going to come from over the next few years. And just look at that slice for smartphones. It's expected to be just 18% of their gross profit. The real money, the future, is projected to come from EVs, their connected devices, and all their other services. So you might be asking, where is all this new profit coming from then? Well, for starters, you've got their AIoT business, that's all their smart connected devices, and that part of the company is just booming. We're talking 45% growth year over year. And if you look even deeper inside that segment, the numbers get even more wild. I mean, check this out. Smart home appliances, things like smart fridges and air conditioners, are growing at a staggering 66% clip. Incredible. But okay, the real headliner here, the biggest piece of news in this entire report, has got to be this. Their brand new electric vehicle division just hit its first ever operating profit. For a new car company to hit that milestone this quickly, that is a huge, huge deal. Okay, but it's not all sunshine and record profits. Despite all that exciting growth, the report points out what it calls a near-term speed bump. And that's got some investors hitting the brakes a little bit. And the analysts in the report, they're really clear about this. They see these current issues as temporary, right? Just a speed bump on a much longer road to growth. But, and this is a big but, for investors who are looking at the next quarter or two, these concerns are very, very real. So what are these concerns exactly? Well, the report lays out 4 key things that are making investors nervous right now. First, analysts are actually downgrading their estimates for smartphone revenue and profit margins. Second, there are these fears that the amazing growth in connected devices might slow down. Third, the EV production isn't ramping up as fast as some would like. And finally, after a fantastic 2-year run of constantly beating expectations, there's a feeling that that cycle might be coming to an end. So, okay, with all of those headwinds, you have to ask, right? Why on earth do the analysts in this report still have a buy rating on the stock? Well, it all comes down to the long-term vision. And this quote right here from the report itself, it just perfectly captures that optimism. They don't see Xiaomi as just a phone company or just a car company. They see it as building this massive interconnected ecosystem for your entire life, what they call the human X car X home strategy. And they believe this is just the very beginning of a much, much larger story. And that bullish outlook, it's really built on 3 key ideas that directly push back against those near-term worries we just mentioned. So number 1, who cares if phone profits are down? They're becoming less important to the bottom line anyway.
Number 2, they think a big push into international retail stores could reignite that connected device growth. And number 3, as they get better and faster at making their EVs, that's going to boost both investor confidence and, of course, customer demand. And all of that confidence, all of that long-term vision, it all translates into a final, very tangible number, a 12-month price target of 65 Hong Kong dollars. Now, at the time this report came out, that represented a potential 24% upside for the stock. Pretty significant. So this all leaves us with the big final question, doesn't it? Can Xiaomi actually pull this off? Can they successfully weave together all these different parts of our lives, the human, the car, the home, into one seamless and, most importantly, profitable ecosystem? That, right there, is the billion-dollar bet this entire strategy rests on.